Hello everyone. Welcome to the third lecture of our module 1, that is investment alternatives. So under this particular topic, what we are going to cover? We are going to cover the rules of investment management, that is the golden rules propounded by some of the investors who are working in financial markets. How much to invest? Again, it is propounded by some of the prominent investors of the financial market. And where to invest, where we are going to focus on the different alternatives and what are the evaluation criteria of selecting this particular financial alternatives in our portfolio. So before starting with this particular portion, let's revise the last two lectures. In first lecture, we are focused on what is investment, what are the nature and characteristics of investment, why particular person invest. In our second lecture, we dwell further into this particular portion and get to know why the particular persons invest and what are the different types of investment avenues. Now under this lecture, we are focusing on the golden rules of investment. So what are the golden rules? The major three golden rules that should be adopted by any individual before investing is they should start early. They should start early in the sense that they should start investing early. When they start income, suppose they have started a particular job or started a particular business, before that they can think about how should I invest. And when they have that particular thinking in the mind, they should start investing. At initial stage, when they start a particular job or start a particular business, they should again start with that particular portion that we need to invest in the financial markets. Why we need to invest in financial market? We already discussed it earlier. So when we start early, that means at the age of 22 or 23 or 24, we can earn a particular amount of money at the time of retirement. So that's why it is suggested that every individual should start early investment. That is a basic fundamental or basic golden rule of investment. Second, invest regularly. This is also very important. Suppose I have 1 lakh rupees I invested in 2024 and next I am waiting for investment in 2026. This particular type of investment pattern is not going to give me any sort of benefit. So what I have to do? I have to invest regularly a certain portion of money, whatever it may be a 500 rupees, it may be 1000 rupees, it may, depending upon a person, it may ranges from 500 to 1 lakh rupees per year or more than that also. But they should regularly invest certain portion of money in any sort of financial instruments which they prefer according to their risk appetite. Third is think long term. Because we have already discussed in our second lecture that there are three categories of investment, that is, one is investor, one is speculator and one is gambler. So we are not speculating, we are actually investing. So whenever we talk about investment, we think about long term investment, not short term. So minimum period for investment should be 5 years. So I should lock my amount, whatever amount I am investing, it should be locked for up to 5 years, so that I can get a good amount of return after 5 years. Again, it depends upon the market condition. If markets are not going good, we can withdraw and again reinvest. But it is suggested that when markets are not going good, we should not withdraw from it, we should invest rather, because if the markets are low, stock prices are also low, it is the best time to invest because we are getting the stocks which we are not able to purchase in other situation. So we should try to invest regularly and think about long term goals, not short term objective. So at Albert Einstein has said, I quote, compound interest is the eighth wonder of the world. So we can understand why we want to invest long term, because we are getting compounding interest benefit. If we want to get the benefit, that's why we need to invest for long term. He who understands it earns it, he who doesn't pays it. That means if we don't understand the basics of compounding interest benefit, then in that case we need to focus on short term gain, and if we want to get benefit out of that particular compound interest, then we have to think about long term gain. So speculators, gamblers, they basically go for short term gains, but investors, they are interested in long term gains. So these are the basic golden rules of investment. Now how much to invest? None of the great investors of the world has suggested how much to invest, but they have suggested that one should decide their investment decision based upon their investment objective, the time horizon they are interested for investment, and the risk appetite they possess. So, these are the basic 3 criteria on the basis of which one can decide how much they need to invest at present. Because in previous lecture I have already mentioned that according to our life cycle, according to our gender, according to our income, our investment decisions also changes. So, no one has suggested that this should be the specific criteria that one should invest, but the basic or the general criteria is 20 to 30% of our income should be invested, so that we can accumulate a good amount of wealth at the time of retirement for ourselves. So, the ideal investment ratio is 20 to 30 of our income. Now, where to invest? So, where to invest means what are the different alternatives. These particular term, that investment alternative, is also known as financial instruments, financial avenues. Do not get confused with this particular terms, because we can know this particular term as financial alternatives, financial avenues, or financial instruments. So, first portion of this particular category is deposits. Deposits are a good portion of financial assets that an individual put in a form of a bank deposit or a corporate deposit or post office deposit. So, these are the 3 conditions where we can put our money. So, if I talk about FDs or RDs, these are basically the deposits where we put our lump sum amount in form of FD, or we put a regular amount, that is suppose 2,000, 3,000, 10,000 in RD. So, these are the deposits. After a maturity period, we will get the principal amount as well as the interest. So, in all the cases, that is bank deposit, post office deposit, as well as company fixed deposit, we get the principal and interest at the time of maturity. So, in the case of deposits, the maturity period is already fixed, the interest rate is already fixed, and we know how much we need to invest. So, it depends upon the investor what they want to invest, but interest rate and maturity period is already fixed by the financial institutions. Next is the government saving schemes. The Government of India offers certain number of saving schemes that are basically the small amount of money that can be put by the investors in these particular schemes. They are public provident fund, where we can go for lump sum deposit as well as regular deposit. National saving schemes, here again also we have to purchase a 5,000 rupees national saving schemes. We can go up to a number of national saving schemes. Then there are certain schemes for senior citizens where they can put their money after retirement. So, these particular schemes help the individual to get a fixed amount of interest at the time of maturity. Again, these particular schemes are for a fixed period. So, maturity period is fixed, interest rate is fixed, and the principal amount, whatever the particular person is interested in investing, they can think about that and they can invest in. Next comes the most important financial instrument, that is money market instrument. What are they? They are the debt instruments which have a maturity period of less than 1 year. At the time of issue, they are called money market instrument because these instruments are highly liquid and having negligible risk. These are mainly issued by the financial institutions to meet out their short-term shortages of fund. So, what are they? First one is treasury bills, which is popularly known as T-bills. It can ranges from minimum 5 days to maximum 365 days. So, they are the short term debt instruments. They are basically issued by Government of India to raise fund, and after a period of time they provide the principal amount plus interest back to the investor. Then certificate of deposit, these are the saving instrument issued by the banks. They are having a fixed rate of interest and having a shorter period of time. Already we have mentioned that money market instruments basically involved a less than 365 days time period. So, these are issued for maximum 365 days. Then comes the commercial paper. They mainly issued by non-banking financial institutions. These are short-term and unsecured promissory note issued by corporation to meet out their borrowing needs. So, it is a type of fixed maturity dates. They are usually issued by non-banks, as already mentioned. These are basically issued by the corporations to raise fund from the public. They can be the public sector unit undertakings or maybe the private sector companies also. They can go for commercial paper, but they are short term borrowings. Then come repo rates. Again, this is a agreement between the borrower and the lender, but it is basically issued by the banks. So, it is a repurchase agreement, is a short term agreement to sell the securities and purchase it back after a certain period of time at a higher rate, so that the other person who is lending the money should get a certain amount of return out of it. So, these are certain types of money market instruments. Next come the bonds or debentures. As we all know that they are the long term financial instruments. The issuer of the bond promises to pay a certain amount of interest at the time of maturity plus the principal amount. The bonds can be classified as government securities, PSU bonds, private sector bonds or preference shares. So, preference shares is not a category of bonds or debentures, it is a separate category, but comes under this category because they are highly secured instruments. So, these four category of instruments under bonds and debentures are highly secured. At the time of default, the government is not able to pay the money back, then they have to sell out their collateralized asset and pay back the investors. So, these are secured instruments and investors get a good amount of return from these instruments. Then comes the equity shares. As we all know, the most people like to invest in equity shares, but what are they? They represent the ownership capital. Ownership capital in the sense, we basically interested in purchasing the share just for selling it and getting a good amount of money. But the basic reason for purchasing a share that you own the certain portion of share in that particular company, you have certain amount of sharing, you have the voting right, you have the privileges that other shareholders possess. So, these are essential for our wealth building. So, what are the different types of equity shares? We can say blue chip shares. Blue chip shares are the topmost companies of any particular country like TCS, IBM. These are certain blue chip companies where investors, if they invest, they will get good amount of return out of it. Growth companies are basically those companies who are working in innovative domain or in the area of manufacturing or IT sector. These particular companies basically have lot many projects with them. So, they do not pay dividend regularly, but what they do, they try to increase the prices of their shares regularly in the market. So, suppose a particular person invested in a growth company and purchased a share at rupees 100, after a year he can see that the price increases to 120 because they depend upon their projects. They have huge amount of projects with them and they need to invest regularly. So, their funds, whatever reserves they have, they are diverting it to these particular projects, and from these projects whatever they are earning, it is reflecting on the stock prices. We will discuss in later on when we go to the efficient market hypothesis, how the market reflect the company's news and all these things. Simply you can understand that these particular companies do not pay dividend, but they pay a good amount of return to the investors, and if they sell the shares, they will earn a huge amount of profit from this. Income shares basically are those companies who are quite matured and are going to pay a good amount of dividend every year. So, these are the shares. Cyclical shares are basically those companies which according to the economic situation or macroeconomic cycles varies. So, these companies move according to the economic cycles and their price movements are based upon this. Then comes the speculative shares. Speculative shares are those shares who are quite volatile in the market, like cryptocurrency companies or innovative companies, renewable energy companies. These are the speculative share companies. According to situation and time, according to macroeconomic conditions, the prices of these shares increases or decreases. So, they are quite volatile and they give a good amount of return to the investors. Then come the mutual funds. What are they? Instead of directly buying equity shares, if a particular person is risk aversive or risk neutral, they are not interested in buying the shares directly. So what they do? They purchase mutual fund, and the fund managers of this mutual fund basically form a portfolio of shares which handles this particular situation for the investor. So we have different types of schemes available: equity, debt and balance. These are the major schemes, but at present there are lot many schemes available. As I already mentioned, that there are hybrid instruments coming in the market. So same way the mutual fund is also growing. So there are ESG mutual fund, there are impact mutual funds. So we have lot many categories of mutual funds. Depending upon your nature, your character, you can invest in different types of mutual fund. Then life insurance again is a particular sort of investment for those who want to cover their risk as well as who want to invest. So in life insurance policies, individuals don't see it as an investment option, but morely it is looked as a risk coverage portion, but insurance companies believe that it's an investment also, because it is providing us tax benefits and it's also providing certain amount of return at the time of maturity, as well as they are covering the risk. So for the purpose of investment, investor can think this particular alternative as investment option if they want to cover their life risk as well as a good amount of return at the time of maturity. So there are certain types of policies: endowment policy, a normal risk coverage policy. It will provide you risk coverage as well as it provide a certain amount of return or bonus at the time of maturity. Money back policy, if suppose the time period of insurance policy is 15 years. So if we have purchased the money back policy, we are going to pay the premium, and after certain points of time, it is going to pay certain amount back to the investor. Whole life policy, it is going to cover your whole life, and after your death, it is be reverted back to the investor's family. Then term assurance policy, it is going to cover a minimum 10 to 65 years of coverage, and it's like endowment policy, it's cover your risk as well as your investment. Both benefits will be available in case of all these 4 types of insurance policies. Then precious object, there are certain category of investors who are not interested in investing in insurance policies or in shares or debentures or government securities. They are interested in purchasing precious objects. So precious objects vary from their sizes. Okay, it can be a small diamond size amount to a big painting. So it vary from shape and size as well as their monetary terms and condition. So a painting can be purchased at 1 crore of rupees, a painting can be purchased of rupees 50,000 also. So it depends upon the investor who are interested in these types of precious instrument. So there are gold and silver, then precious stones like diamonds, rubies, emeralds, etc. Then art objects like paintings, then other artifacts which are available. Then bullions means the coins that are old age coins. Some investors are also interested in investing their money or putting their money in these types of instruments. By selling this instrument in the market, again they need to think about the marketability, because these are quite specific instruments and the market is quite limited. So when we talk about marketability and liquidity in our first lecture, these particular instruments also come under that category. In case of gold and silver and precious stones, the marketability and liquidity is high, but in case of art objects and bullions, the marketability is low, because we need to search for those persons who are interested in these types of instruments and they are going to purchase it. Then real estate, there are certain category of investors who are having good amount of money with them. They are interested in purchasing the residential houses for themselves or investing in plots for themselves. So in addition to residential houses, the affluent investors are interested in following type of real estate, that is agricultural land, they can go for that. Semi-urban land, again they can go for that and build a particular building or hotel or any sort of thing in that particular thing. Commercial property, real estate funds, that is also a hybrid sort of fund that is available nowadays. Then real estate investment trust, they can open that also, or they can invest in this type of trust also. So persons who are affluent enough to go for real estate investment, they can go for these categories of investment. Then come financial derivatives. So we look into this particular concept in our later videos, but for the initial stage we just go through that financial derivatives are an instrument which derives its value from the underlying instrument or underlying asset. So if we talk about future and option, the underlying asset, if suppose it is a share, then it is a equity option or equity. They can go for commodities also, then it becomes a commodity derivative, where we have gold, silver as well as wheat or other grains, they are under commodity derivatives category. Now comes the criteria for evaluation. How we going to evaluate these particular things? So when we talk about the different financial instrument, a person need to think which particular instrument is beneficial for them. It is already mentioned in previous slides that there are three conditions, that time horizon, the investment objectives and the investor preference, that where he wants to invest, how much he wants to invest and for how long he wants to invest. These are the basic thing, plus what are the criteria for evaluating this particular thing. The first is rate of return, which instrument is going to give me good amount of return, that will be selected for my investment for basket. But how I going to select it? Again it depends upon my risk appetite. If I am a risky person, then I am going to choose those shares which are quite volatile. So that is speculative shares. If I am a person who is interested in regular income, then I am going to say purchase income shares. Again it depends upon my nature. I am interested in purchasing T-bills, I am interested in purchasing real estate. So it depends upon the individual, but what return he is going to get from that particular security investment, he has to think on the basis of that, because we have already said that on the basis of risk return trade-off, an individual select his security. So risk, again certain individual financial instruments are quite risky and some instruments are not at all risky, like money market instruments are not risky. They are having less maturity period and good amount of return we can get after the maturity. Government securities, again they have less amount of risk involved. Shares or equities, high amount of risk is involved. Instrument is good for us and how much risk we are going to absorb by purchasing that particular security. Then comes the concept of marketability. Marketability, as I already said, that how easily we can sell that particular product in the market. In case of precious objects, there are certain objects like artifacts as well as paintings, bullions, these cannot be easily sold. We need to find the person who is genuine enough to purchase these particular items. So the marketability of these particular instrument is quite low. Tax shelter, where we going to get the tax benefits. So in case of insurance policies, we are getting the tax benefit, but with the coming of new tax regime, there are certain changes in the rules and regulation. Convenience, how easily we can get the financial instrument from the market, or how easily I can purchase the financial instrument in the market and sell it in the financial market. So these 5 points are very essential for evaluating a particular individual security. So whenever you are purchasing a particular security, it is essential that you should evaluate it on the basis of risk and return, the tax benefits which we are getting, the convenience at which we can purchase it and sell it, and the marketability of the share. Otherwise what will happen, we will put our money and will be get blocked and will not be able to sell it easily, and we are in a loss making situation in that condition. So it is better to evaluate the security on the basis of these 5 criteria and decide which security is good for me. So here are some suggested readings. You can go through these particular books for a better understanding of this concept. Thank you.